Thank you, Jeremy, and good morning, everyone. Thank you for joining me on the call this morning. As Jeremy said, I'm Matt Cable. I'm lead manager of Jupiter Rights and Issues Investment Trust, and it's a pleasure this morning to be talking to you about one of the most venerable UK equity trusts on the market today. While I give you a quick introduction to the trust, I'll just leave the risk slide here for those who do want to have a read of that. So if you haven't met Rights and Issues before, it traces its history all the way back to 1962, and its history took a significant turn in 1984 when a gentleman by the name of Simon Knott took over management, a position that he held then for 39 years, running it pretty much as a one-man band, leading up to his retirement just over 2 years ago when the trust came over to Jupiter, initially under the management of my predecessor, Dan Nichols, but following his retirement last year, I've taken over management of the trust. Very brief note on the name for anyone who hasn't come across it before. The term Rights and Issues relates to the process that the fund followed in its very early years, so pre-Simon. It's not what Simon did, it's not what we do today, but it's, I guess, it rolls off the tongue, so we've kept the name for posterity. So things that I'd like to talk to you about today, a little bit about how a little introduction to the team and to the range of funds we run and where Rights and Issues fits in, and then focus on the investment process we follow for those who haven't seen that before. So I'll talk particularly around how we do stock picking, and then I've got a few bits of data to show you that may offer some reassurance to those of you who, like me, who have been sort of suffering through the difficult time for UK smaller companies. So a little bit of a reminder of why over the long term we think this is an exciting place to be. And I will make sure we have a little bit of time at the end to talk about, to take some questions. So just briefly introducing the Jupiter team. What you've got on the slide in front of you is Jupiter's core small and mid-cap team. It's a team led by Tim Service. Tim is also my deputy manager on Rights and Issues. Tim leads on our mid-cap funds, and we're supported by investment manager James Gilbert and our analyst Claudia Ho. And those of you who follow UK small and mid-cap will probably know that this is essentially the successor team to what was Merian, what was Old Mutual, and the process that we follow is one that has flowed all the way through that history. We are, of course, supported by Jupiter's wider investment platform. So we've got a couple of the teams represented on the slide in terms of governance and ESG, given their importance to what we do. But of course, we're also supported by an in-house dealing team, risk management, data science, compliance, and so on. The other thing that's worth mentioning at this point is that we also sit as part of the wider UK investment group at Jupiter, and that's a group that's been joined over the last year by UK Dynamic team led by Alex Savides and the income team, Adrian Gosden and Chris Morrison. And I think the reason I mention that is that it underlines that Jupiter very much is still a place which believes in UK equities and sees a future for the asset class. And so it's actually quite a large and diverse group that looks at our home market. Just as a final little bit of orientation before I get into the core of it, these are the funds that we run on the mid and small cap desk, and what you can see here on the left hand side of the slide are the two small cap funds that I lead, so an open-ended fund, UK smaller companies, as well as Rights and Issues, the investment trust, and then the funds on the right are the ones that Tim leads on, which are more mid-cap oriented. And the important thing to draw out from this, captured by our little snappy slogan at the top there, one team, one process, is that what we're trying to do is apply the same investment logic, the same process across all of these funds. And then we apply that process, we express that process in a way that suits all the individual mandates and objectives of the funds. And one thing that you may notice on the slide on the typical holdings line is that Rights and Issues is the most concentrated, high conviction expression of that process. So this is very much about taking larger long-term positions in our most high conviction ideas, taking a long-term view, and obviously accepting that there'll be some more sort of volatility along the way, given its closed-ended structure. So where I want to spend most of the time today is just talking a bit about our investment philosophy and approach to running these all of these portfolios and rights and issues in particular. And we talk about 4 principles that underlie that. And I'm going to spend most of the time talking about stock picking because that's the core of it. We consider ourselves first and foremost as a group of stock pickers, and we'll tie that back into why UK small caps are an interesting place a little bit later on. But I'll just briefly touch on the other 4 elements now before going into the detail there, and going around in a clockwise direction. So starting with the macro, and we do have a macro top-down input into the investment process, but we're very driven by this concept of being macro aware rather than macro led. So we're very conscious that businesses can't operate in a vacuum and that macro factors can be very important, macro events can be very important to them. At the same time, we're not attempting to forecast inflation, second guess central bankers, predict presidential election outcomes. But what we are trying to do is be conscious of where where market leadership is, the kind of stocks that are working at any given time, and make sure that portfolios are appropriately aligned to any trends or themes. For what it's worth, where we sit today, we find market leadership very mixed. There are a few clear directions, things change a lot. But that's equally important to recognise, because what it means is that we try to run the portfolios in quite a balanced way and try to avoid having unintended exposures in any direction. And that leads on to the next point as we move around, which is risk control. And one of the things that we've developed a little more recently are some fairly sophisticated tools, both off-the-shelf tools and things we've developed in-house, to make sure we really understand where the portfolio's exposures sit and to manage them according to what we're trying to do from that top-down perspective. So that has become a core element of the process. The final point on here, transparency. I mean, we think that's a very important philosophy to uphold in any case. But the reason we put it as part of the process is that it effectively keeps us honest with the other elements. So we expect to be able to talk about anything we do in the portfolio and explain how it fits the rest of the process, and to be held to account both internally and externally on that basis. But coming back to the core of the process, which is stock picking, and essentially we talk about 3 elements here which we believe drive performance in the small and mid-cap space over time. Growth, upgrades, and re-rating. So growth, this I guess is the core of the philosophy, which is to say that the whole point of investing in smaller companies is to find those that are capable of becoming the big companies of the future and growing over the long term. There are a number of things number of characteristics that you can look for that underpin that growth. So that might be classic capital return growth. So businesses with high barriers to entry that are able to earn high returns on capital and then are perhaps exposed to some sort of long-term secular growth driver that allows them to reinvest that capital and go again and have that capital flywheel. Equally, what you could have here are businesses with very strong franchises or brands. So you can think of some of the things like the Rightmoves and Auto Traders of this world, where they've built up very dominant positions in particular sectors that allow them to grow rapidly over long periods of time. This could also bring in disruptors when we talk about riskier high growth. So businesses that are fundamentally doing things in different ways that allow them to take share in particular markets. Or it could also be sort of roll-up strategies, so businesses that are consolidating more fragmented markets. But whatever it is, we need to be very clear on why that strategy allows the business to grow faster than the market over time. What we then look for are what we describe in a word as upgrades, but essentially this is undiscovered growth, so surprises to the market. And again, small cap is a great hunting ground for that, because these are businesses which typically are less well researched, less well covered, less well owned. And we're looking for those situations where those growth characteristics exist, but that's not fully appreciated by the market, and therefore you're able to generate positive surprises on a regular basis, which often drives share prices. And then the final element, re-rating, this is, I suppose, the end of that process where the market cottons onto what's going on with the stock and then takes a fundamentally different view to the company's value and drives performance that way. And it's probably a statement of the obvious that the most interesting situations are where these three elements come together. So that re-rating, that change is often around something within the business changing. So it might be a management change, it might be a change of strategy, it might be something external, a fundamental change to the way some sort of market works. But by understanding what's going on and how that might drive faster growth, we can find opportunities that will then surprise the market over time, and you get that wonderful flywheel of all three working together. You will see at the bottom of the slide, we talk about a little bit about core and opportunistic holdings. In truth, that's a bit more of a spectrum than it is a sort of binary classification. It's fair to say that rights and issues with that highly concentrated, high conviction approach is more tilted towards that sort of core holding. So looking for that strong long-term growth with those fundamental growth characteristics. What we're not doing with rights and issues is chopping and changing regularly as things evolve. So what does that look like in practice? Well, the simple answer is a lot of legwork. So as a team, we spend a lot of time meeting companies, visiting sites, talking to sell-side analysts, building our own financial models, etc., etc. But we try to distill that effort down broadly into three areas as shown on this slide. And it should come as no surprise that the first one is the caliber of management. And we do think that particularly in the smaller company world, management caliber is hugely important, perhaps more so than sort of the larger peers. And I don't think that's simply because if you're in a big company, as a CEO, as a senior leader, you've got lots of people around you, lots of infrastructure, lots of support, and the business only changes slowly. There's only so many different things your business can become. Down at our end of the market, very often the CEO is doing an awful lot of the legwork themselves. The CFO is probably doing far more than just running the finance function. And so the characteristics of those people become hugely important. And we've just listed here some of the things which we think are critical there. And track record, I suppose, is obvious. You know, we like people who've been there and done things. But we have got integrity at the top of the list. And I think it would be fair to say that it would be very rare that we'd ever invest with somebody who we didn't feel had been completely straight with us. We mentioned alignment on here as well. Something that we spend a lot of time looking at is how management teams are incentivized, what their drivers are. We, of course, at our end of the market will often meet founders who are running businesses and understanding their motivation and how they are aligned with sort of the broader shareholder base. We then obviously spend a lot of time thinking about business quality, and a huge amount of that is the legwork. So we spend time trying to speak to or get feedback from customers, suppliers, staff. We look at the nature of the product or service, and of course this can be very different depending on which sector you're looking at. But what we do insist on is that we really understand the business and the markets that it's in before we'll do anything. The setup is an interesting one. This is something that we talk about particularly around timing of making investments. So this is understanding things like the makeup of a shareholder register, market expectations. So we talk here about the marginal bull and bear debate. So what is it that other investors are thinking about, talking about with relation to the stock, and do we have an edge on that debate? And that, as I say, will often speak to the timing of what we do. And so it's pulling all of that together and feeding it into that desire for growth, for surprise, and for change that helps us with our investment process. So I want to spend a few moments now just talking a little bit about UK smaller companies in general. And I'm very conscious that doing this at the moment is a challenge. I think it was about Friday last week, the FT ran with the headline that the UK smaller companies were the most unloved asset class in the world, and it does feel like that sometimes. I'm also conscious that smaller companies, fund managers like me, have been banging the table and pointing at the big valuation discrepancies with other global asset classes for a long time, and that hasn't to date corrected. And it was interesting to hear Jeremy asking questions about that earlier, and maybe we'll touch on that what might change. But what I really wanted to do was just remind everyone of some of the characteristics of this part of the market that make it so interesting, and why we think that, notwithstanding where we are in that cycle of doom and gloom, that there is an opportunity there for those with a sort of longer term time horizon. And I'm going to start with, I suppose to a certain extent, a statement of the obvious, that as an asset class over the very long term, it has delivered some very attractive returns. So this is data from some London Business School professors. They're the people who actually invented the benchmarks that we use, what are now the Deutsche Numis series of indices. And I suppose sort of the statement of the obvious here is that relative to some other UK asset classes, which are represented by those bars on the left-hand side of the slide, equities have done well. And it's a statement of the obvious and should surprise nobody, but sometimes we do need that reminder that there is a return opportunity by being in that higher risk end of the sort of the asset spectrum and equities. But what I really wanted to draw your attention to on this slide, what I think is really interesting, is the upward slope across those different bars, because what those bars represent are different benchmarks cutting the UK market by size. So the all share, which is 1, 2, 3, 4, 5, fifth bar across. So that's the FTSE all share, which everyone will no doubt be familiar with. The other bars are all these London Business School indices, large cap, mid cap, small cap, and micro cap. And without going into the detail of how they're all derived, they're essentially using different cutoffs for size. The core small cap one is the bottom 10% of the UK equity market by value. And what's really interesting is that you get this very clear correlation between smallness and returns over the long term. And accepting that this is very long term, this if you haven't spotted the caption, this runs from 1955 to 2023. And that's the full data series that LBS publish. But what it's showing you is that some of the characteristics of smallness are a driver of return over the very long term. And a lot of those things are things you'll be familiar with if you follow the small cap world. So things like less research coverage and just the law of small numbers. So businesses that start very small that can grow over the long term. And I think it is just important to hold on to this point in these periods, which we have had in the past, where the asset class becomes very out of favour. Those are just some more recent annualized returns for those benchmarks, which you can look at if you want to. So the next point I wanted to make, excuse me one moment, is around the dispersion of returns at the two ends of the UK equity market. So what this chart shows you are the annual, the percentage returns. This is over a year to last September, as it happens when we cut the data, but it would look the same over any period. The dispersions of returns for the FTSE 100, the lines in black, which as you can see are quite tightly crowded around the centre of the chart, and then the returns on the Numis Smaller Companies Index, which, as I just talked about, the bottom 10% of the market by value, which are the blue bars, which as you can see are much more spread out. And what that's showing you is that this is a less efficient market. The outcomes, even over a 1 year period, are much wider spread. And what that means is that as there's an opportunity for stock pickers with an effective and well-applied process to pick the winners and hopefully avoid the losers, because clearly the two ends, there are two ends to that distribution. And you'll see there's a few stocks that ended up in that -100 bucket on the left-hand side. So there's an opportunity, or a greater opportunity, to add alpha in this end of the market. The question is, does that happen in practice? And that's where this chart comes from, which I think is really interesting. So this is looking at cumulative returns over 10 years. I think we last did this analysis in up to the end of last August. But again, it looks similar over different periods. So this is cumulative returns over 10 years for the median fund in a selection of investment association sectors relative to its benchmark. And what you see on the left in the global IA global sector is that the median fund significantly underperforms, and that perhaps is no surprise. So that's partly the effect of fees on returns, but also the fact that it's a big, efficient market dominated, of course, by the US, which is the next bar along, and it's hard to generate alpha in that situation. And perhaps completely unsurprisingly, has been part of the driver behind the shift to passive investing over the last few years. As you come down to smaller, more local markets, that underperformance starts to disappear. So you can see European and the UK all cap bars are negative, probably to about the scale of you'd expect for fees over a sort of 10-year horizon. Emerging markets are a little smaller. And as you'll see on the right-hand side, the punchline is that the UK smaller companies sector has actually driven some outperformance over that period. So the median fund in the UK smaller companies sector outperformed its benchmark in the 10 years to last August. And I think that is fundamentally for the reason that I alluded to on the previous slide, which is that these markets are less efficient and there are greater opportunities for stock pickers. Now, clearly there's a bit of been a little bit selective with which things I put on here to make the slide readable. It is fair to say that you get the same pattern if you look at European small companies or even North American smaller companies. It's definitely a smaller company characteristic. So with that, I hopefully what I've given you is a quick overview and insight into what Rights and Issues is, how we run it, the team behind it, and just some reassurance for those of you like me who are sort of sticking with UK smaller companies, that there are some fundamentals that sit behind our optimism. And while it's very, very difficult to call the timing of the sort of rejuvenation of the asset class, there are reasons to think that over the long term, there are some opportunities there. So hopefully I've got a few minutes left for some questions, whether Jeremy has some or anybody else.
Yeah, it's fascinating. Thanks indeed, Matt, for the update there from Jupiter. Just to follow up on a point I asked Thomas Moore from Aberdeen, and that is about catalysts that you see that could well help create good environment for investment and better returns for UK small caps.
Yeah, so there's no easy answer to it, of course. I think part of it is understanding what has caused this period of underperformance in the first place. And I think you do go back, 20 odd years to changes to, or longer, to changes to pensions and effectively the changes to pension rules and the move away from DB to DC pensions, which means that those DB pensions have matured and you've had that sort of that demographic shift within the schemes, which has pushed asset allocation away from equities and towards fixed income and other asset classes that you would later in life, which has coincided with a period where I suppose the financial zeitgeist has been towards global diversification. All of which means, as I'm sure people know, that the asset allocation to UK equities has fallen from sort of 40% in a typical DB fund, 25 years ago to I think it's about 4% now, which is about the weight of the UK in global index. So part of the answer is that hopefully that process has now run its course, and so that just de-equitization of the UK comes to an end, and that helps to reverse or at least stabilize flows. I think in the more immediate term, there's been a lot of talk in and around government about reforms that are needed to support the UK market. We had Julia Hoggett, who's the CEO of the LSE, talking to us a couple of weeks ago. And there are lots of individual things that are going on, which I could talk about, all of which are important and interesting. So changes to listing rules, potential changes to ISAs and pension rules, simplifying processes, making IPOs easier, all these good things. But probably the more important thing is that what it's telling you is this is now being taken very seriously by government. So whether any of those individual things in itself is a specific catalyst, I don't know. But the fact that we actually now have a genuine concern about the UK capital markets and the equity market in particular, I think is a helpful leading indicator in where things might go. I mean, I think in the even shorter term, we've been talking for a long time about, I suppose, the need for the US and in particular the Mag 7 to stop working, so that people think a little bit more broadly. And it's interesting because often I talk to the IFAs and the wealth managers who are not our end customers but our intermediaries, and there's a lot of understanding and acceptance of the idea that that the UK opportunities are or UK small caps are an opportunity. How that's a really hard conversation with a client when it's worked for
me.
10 years.
Sorry to interrupt you, but for me, the point is here is that it should not be led by politics. Politics getting in the way of investment, for me, is not a free market. It's not an opportunity with long-term benefits. For me, what the politicians should be doing, and you agree with me, is give a better environment for people to invest in these small cap companies. Give them the tax breaks, give them the opportunities, give them the expanded horizon that I think is so much needed within the small space sector. All we can see from politics is clamping down on other areas which restricts their activities. What are your thoughts on that?
Yeah, no, I 100% agree with you, and this shouldn't be. I think any suggestion of mandation, of forcing people to invest in a particular area, is a terrible idea. Yeah. This is actually about removing a lot of the either regulation or perverse incentives that have been put in place in the past that have actually made it harder or less attractive to invest in the UK. So, we talk about things like the MiFID rules and the bundling of research, which has caused a huge disruption on the sell side and has definitely reduced the quality and quantity of research that we see. Yeah. So if you can take some of those rules away, you can start to undo the damage. Absolutely agree with you, though. Coercing people is not the answer.
Yeah. Pick up on a couple of other questions very quickly. Given the strong returns of micro caps, why have you cut off at £100 million for micro caps? What is it about that sector you can't expand any further into?
So we don't apply a hard limit to market cap. What we have to think about, though, is liquidity and liquidity relative to opportunity. So we do own some smaller companies than that, and where you can see that sort of very clear long-term path to becoming a bigger company and therefore generating the higher liquidity later on. Absolutely willing to do that, and Rights and Issues is a great vehicle for doing that relative to, say, an open-ended fund where you might need to be a little bit more nimble and can't necessarily take that long-term view. So no, I think that microcap part of the market is very interesting. You just need to be a little bit more selective because it's very easy to get into something and get stuck in it at that end of the market cap spectrum.
Yeah. Just very quickly, one of the other questions has come up. What do you think about defence stocks at the moment? I'm just looking at some breaking news coming across. Chinese representatives in America have said if war is what the US wants, now of course we're talking here initially about potential trade war. If war is what the US wants, be it a tariff war, trade war, or any other type of war, we're ready for it. That's what China's saying. An escalation of the geopolitical problems, massive headwind, isn't it, for investment?
Yeah, I mean, clearly, if World War III breaks out, all bets are going to be off. It's not a risk that I spend my time trying to manage in the portfolio because we're going to have bigger problems. I mean, I think to your point on defence, clearly the announcement coming out of Germany over the last 24 hours in terms of what their plans to spend, what the UK has decided to do. This is going to be a big tailwind for the sector, and the UK does defence really well. So. It's something that we are already exposed to, but we're also thinking quite hard about where those biggest opportunities are going to be. Because I mean, it is going to be a more dangerous world. This is definitely a sector that's going to be a winner.
Yeah. Just briefly away from defence stocks, particularly. I know in your presentation you've got a list of your top holdings. Just very quickly, talk to us about what 2025 is going to look like from here on in, and where you're expecting the money to go.
Well, so I think it's going to be very volatile through the early part of the year. I think, unfortunately, we're back to that stage where most of us investors wake up every morning and see what Mr. Trump has tweeted, and we'll just see things moving around a lot. That will create some opportunities, but we're going to need to be very judicious, and we will move quite slowly on that because you can clearly you can be wrong quite quickly. So I think you're going to see the first half of the year being quite volatile and quite difficult. The hope is that some of that settles down as we go through the year. And actually, in the UK particularly, I think there are some reasons for some optimism later in the year, and hopefully we'll start to see that coming through a little bit in valuations and stock performance.